how Venmo and digital payments are killing physical money. The generation that splits dinner bills on apps rarely touches coins or bills. Picture this. 5 college friends finish dinner at a trendy downtown restaurant. The check arrives for $127.43. Instead of fumbling through wallets, calculating who owes what, and scrambling for exact change, one person pays with a card while the others instantly send their share through Venmo. 20 seconds later, everyone's settled up, complete with pizza emojis and inside jokes in the transaction descriptions. This scene, replicated millions of times daily across America, represents the quiet assassination of an institution older than civilization itself: physical money. For over 5,000 years, tangible currency has been the backbone of human commerce. Kings stamped their faces on coins, governments printed elaborate bills, and entire economies ran on the rustle of paper and clink of metal. But in just 16 years, from 2009 to 2025, digital payments have systematically dismantled this ancient system with surgical precision. What we're witnessing isn't just a technological shift. It's the methodical execution of cash itself. The weapon of choice in this financial revolution came from an unlikely source: a startup founded by 3 strangers who met on Craigslist. Andrew Cortina and Ikram Magdan Ismail, 2 University of Pennsylvania graduates, were frustrated by the hassle of splitting costs during a weekend trip. They wanted to send money as easily as sending a text message. Their solution, launched in 2009 as Venmo, transformed the simple act of paying someone into something resembling social media. But Venmo didn't exist in isolation. It was part of a perfect storm that began brewing in the late 2000s. The iPhone had just revolutionized how people interacted with technology, making complex transactions possible with a few taps. The 2008 financial crisis had shattered trust in traditional banking, making consumers hungry for alternatives. Millennials, scarred by witnessing their parents' financial struggles, were eager to embrace anything that promised transparency and control over their money. Meanwhile, traditional banking remained stubbornly antiquated. Wire transfers took days, carried hefty fees, and required enough paperwork to choke a bureaucrat. Into this void stepped not just Venmo, but an entire ecosystem of digital payment solutions that would collectively strangle physical currency. The assassination of cash required more than just smartphone apps. It demanded a complete reimagining of financial infrastructure. PayPal, founded in 1998, had already established the foundation by proving that digital transactions could be secure and reliable. When PayPal acquired Venmo in 2013 for $800 million, it wasn't just buying a company. It was purchasing the future of peer-to-peer payments. But Venmo's true genius lay in understanding that payments aren't just financial transactions. They're social interactions. By adding emoji, comments, and public feeds to money transfers, Venmo transformed the mundane act of paying back a friend into a form of entertainment. Suddenly, splitting a pizza wasn't just settling a debt. It was creating a shared memory with crying, laughing emojis and references to your friend's questionable topping choices. This social element proved addictive, particularly to younger users who grew up sharing every moment of their lives online. Apple recognized this shift and launched Apple Pay in 2014, allowing iPhone users to pay for purchases with a fingerprint scan. Google followed with Google Pay, while Samsung created Samsung Pay. Each platform chipped away at different aspects of physical currency's dominance. Apple Pay conquered retail transactions, Venmo dominated peer-to-peer payments, and services like Zelle, launched by major banks in 2017, captured the market for larger transfers between accounts. The numbers tell the story of cash's systematic dismantling with brutal clarity. In 2009, cash accounted for 62% of all transactions under $10, the bread and butter of physical currency's relevance. By 2022, that figure had plummeted to just 18%. Venmo alone processed over $240 billion in transactions during 2022, a staggering increase from just $12 billion in 2014. But the real killer blow came from contactless payments. Before 2020, American adoption of tap-to-pay technology lagged behind other developed nations, with only 15% of transactions using contactless methods. Then COVID-19 arrived like an accelerant on an already burning fire. Suddenly, touching physical money felt dangerous, even deadly. The phrase, exact change only, disappeared from stores as merchants actively discouraged cash payments. Contactless payment adoption exploded to 51% by the end of 2021. Credit card companies had spent decades trying to eliminate cash through rewards programs and marketing campaigns, but a global pandemic accomplished in 18 months what they couldn't achieve in 20 years. The Federal Reserve reported that cash payments, which represented 26% of all transactions in 2018, dropped to just 19% by 2022. Among adults under 30, that figure was even lower. Just 11% of their transactions involved physical money. The generation driving this transformation doesn't just prefer digital payments. They've been systematically conditioned to view physical money as inconvenient, unsanitary, and socially awkward. College students today routinely go weeks without touching cash, conducting entire lives through digital transactions. They pay for coffee with Apple Pay, split Uber rides through the app, send rent money via Venmo, and buy everything from textbooks to late-night snacks through various digital platforms. This behavioral shift represents more than convenience. It's a fundamental rewiring of how young people conceptualize money itself. To previous generations, money was tangible, finite, and real. You could feel its weight in your pocket, count it in your hands, and watch it disappear as you spent it. Digital natives experience money as abstract numbers on screens, transferred instantly across networks with transaction history stored in the cloud. The psychological impact of this shift cannot be overstated. Physical money provided built-in spending controls. When your wallet was empty, you stopped buying things. Digital payments remove these natural barriers, making money feel limitless even when bank accounts tell a different story. Studies show that people spend 12 to 18% more when using digital payment methods compared to cash, partly because digital transactions don't trigger the same psychological pain of paying that comes with handing over physical currency. The infrastructure supporting physical money began crumbling under coordinated assault from multiple directions. ATM usage peaked in 2008 and has declined steadily ever since, dropping 23% between 2018 and 2023 alone. Banks responded by closing ATM locations and reducing cash services, creating a self-reinforcing cycle where cash became harder to access, driving more consumers toward digital alternatives. Retail businesses accelerated this trend by implementing cashless policies, particularly in urban areas where digital payment adoption was highest. Coffee shops, fast casual restaurants, and retail stores discovered that eliminating cash reduced theft, sped up transactions, and simplified bookkeeping. The COVID-19 pandemic provided perfect cover for businesses that wanted to go cashless but feared customer backlash. Suddenly, refusing cash wasn't about discrimination or inconvenience, it was about public health. Even traditional cash-heavy industries began defecting. Taxi companies, once synonymous with cash transactions, were obliterated by rideshare services that made digital payments mandatory. Food trucks, historically cash-only operations, adopted Square readers and smartphone payment systems. Street vendors began displaying QR codes for digital payments. Each conversion represented not just a business decision, but another nail in cash's coffin. The network effects of digital payment systems created an unstoppable momentum that physical money simply couldn't match. Unlike cash, which required physical presence and exact change, digital payments offered features that seemed almost magical by comparison. Venmo users could send money instantly to anyone with a phone number or email address, complete with messages, photos, and payment requests. The platform's social feed turned financial transactions into entertainment, allowing users to scroll through friends' payments like a Facebook timeline. This social element proved particularly powerful among younger users who had grown up sharing their lives online. Paying someone became an opportunity for humor, inside jokes, and social connection. Digital payment systems also offered conveniences impossible with physical money. Automatic splitting of group expenses, recurring payments, instant refunds, detailed spending analytics, and integration with budgeting apps. Businesses could process digital payments faster than counting cash, eliminate the risk of counterfeit bills, and avoid the costs associated with handling physical currency, bank deposits, counting, security, and theft prevention. The compound effect of these advantages created a network where every new user made the system more valuable for existing users, while simultaneously making cash less relevant for everyone. Government policies and regulatory decisions inadvertently accelerated cash's demise through a series of measures that favored digital transactions. The Federal Reserve's decision to keep interest rates near zero after 2008 made it expensive for businesses to handle cash, as the opportunity cost of maintaining cash registers, safes, and daily bank deposits rose compared to instant digital settlements. Anti-money laundering regulations increased the compliance costs associated with cash-intensive businesses, making digital transactions more attractive to merchants who wanted to avoid regulatory scrutiny. The IRS began requiring more detailed reporting for cash transactions over certain thresholds, while simultaneously making it easier to track and report digital payments. State and local governments contributed by implementing digital payment systems for taxes, fees, and services, normalizing the expectation that financial interactions should happen electronically. Even the physical design of new public spaces reflected this shift. Parking meters accepted credit cards and mobile payments, public transportation systems implemented contactless fare card systems, and government offices installed digital payment kiosks. Each policy change further marginalized cash users, creating barriers for people who preferred or needed to use physical currency, while simultaneously providing advantages to those who embraced digital alternatives. The businesses that thrived during this transition shared common characteristics that revealed the blueprint for cash's destruction. They understood that payments weren't just about moving money. They were about creating experiences, building relationships, and solving problems. Venmo succeeded because it made boring financial transactions fun and social. Square revolutionized small business payments by making credit card acceptance affordable and simple. Apple Pay won customers by making purchases feel secure and effortless. These companies didn't just compete with cash on functionality. They made cash feel obsolete by offering experiences that physical money could never provide. The most successful digital payment platforms also understood the importance of psychological factors in financial behavior. They used sophisticated user interface design to make spending feel painless, implemented reward systems that encouraged usage, and created social pressure through features like Venmo's public feed. They also leveraged data analytics to provide insights that cash could never offer, spending categorization, merchant recommendations, and budgeting tools that helped users feel more in control of their finances, while simultaneously encouraging more transactions through the platform. The casualty count from this financial revolution extends far beyond just coins and bills. Entire industries built around physical money faced extinction. Check cashing services, once thriving businesses in low-income communities, saw customer bases evaporate as digital alternatives became accessible to previously unbanked populations. Coin-operated laundromats retrofitted machines to accept card and mobile payments, or faced obsolescence. Parking meter manufacturers pivoted to digital systems or disappeared entirely. Bank branches, once necessary for basic cash services, closed by the thousands as customers handled routine transactions through mobile apps. The businesses that survived did so by adapting quickly and completely. Traditional banks launched competing payment apps, acquired fintech startups, or partnered with existing platforms. Retailers invested heavily in point-of-sale systems that could handle multiple digital payment methods. Even industries that seemed cash-dependent found alternatives. Street performers began accepting Venmo donations via QR codes, charity organizations implemented contactless giving systems, and farmers markets set up mobile payment processing stations. As we stand in 2025, the assassination of physical money appears nearly complete, with digital payments achieving what seemed impossible just 2 decades ago, making cash feel primitive, inconvenient, and socially awkward. The statistics paint a picture of systematic destruction. Cash now represents less than 15% of all transactions in the United States, down from over 60% in 2009. Among adults under 25, cash usage has virtually disappeared for routine transactions, relegated to occasional tips, emergency situations, and transactions they prefer to keep off digital records. The COVID-19 pandemic served as cash's final death blow, accelerating trends that might have taken another decade to fully materialize. Businesses that had hesitated to go cashless found perfect justification in public health concerns, while consumers who had resisted digital payments were forced to adapt or face significant inconvenience. The network effects have become self-sustaining. As fewer businesses accept cash and fewer people carry it, the remaining holdouts face increasing pressure to join the digital payment ecosystem. Even traditionally cash-heavy demographics are adapting, with senior citizens adopting digital payment methods at unprecedented rates and low-income consumers gaining access to banking services through smartphone apps that would have seemed like science fiction in 2009. The companies that orchestrated this transformation, Venmo, Apple, Google, PayPal, and dozens of others, didn't just create better payment methods. They fundamentally altered human behavior around money, turning financial transactions into social experiences, data collection opportunities, and profit centers that generate revenue from every swipe, tap, and transfer. Physical money, which survived the rise and fall of empires, world wars, and economic collapses, couldn't survive the smartphone revolution and a generation that splits dinner bills with emoji-laden messages that turn debt settlement into entertainment.